Hi, this is Rick Adams from practicalcsm.com, and you are listening to part one of a three-part recording of my recent and very interesting conversation with Rav Dhaliwal, entitled Customer Success Management from the Investor's Perspective. What makes this discussion particularly interesting, in my opinion, is the experience that Rav brings from both his time as a customer success leader and his time as a venture capital investment partner. So he really has seen things from both sides of the fence, and perhaps therefore has a unique viewpoint that is well worth listening to. Please enjoy part one, and parts 2 and 3 will be released very soon. Hi, my name is Rick Adams from practicalcsm.com, and today I am joined by Rav Dhaliwal. Rav's name might be familiar to you for a couple of reasons. Firstly, Rav is a well-known customer success expert who often appears in interviews, webinars, and so on, including, of course, his appearance as a panel member on my own company's recent webinar in July, titled What Will Be the New Normal for Customer Success, which was a great success, not least because of Rav's excellent and insightful comments and observations. And the second reason why you might recognize Rav's name is that he used to be the head of customer success for the EMEA region for Slack. So if you use Slack and are in that region, you may well have come across him there. Prior to Slack, Rav had an extensive career in customer success management, but after leaving Slack in 2019, Rav became an investment partner at Crane Venture Partners, a venture capital fund that invests in ambitious, intelligent computing companies in Europe. I believe this history of experience as a CSM, as a senior executive decision maker in a tech company, and finally as an investor in tech startups, gives Rav a unique and very powerful perspective on the customer success management profession that is well worth listening to. And of course, that's why I'm particularly pleased to welcome him to the podcast show to talk to me today. Rav Dhaliwal, thank you very much for agreeing to come on as a podcast guest. It's great to have you here.
Thank you so much, Rick. It's great to be here. I really appreciate the invitation.
Yeah, my pleasure. And the topic for today's conversation is customer success management from the investor's perspective. And I'm really excited to be talking to you about this very interesting subject. And to my mind, the investors are actually very important people within any business because, after all, they're the ones that provide the funding that allows the company to perform its activities. But more than that, they are also usually very experienced and knowledgeable business people who know a thing or two about how to run a successful business. So from my perspective, they are people whom the rest of the business should definitely be paying attention to and listening to and perhaps taking advice from as well. And I believe that whilst a lot of this advice might be of specific interest to customer success leaders, it's also very useful for regular CSMs at all levels to understand the investor's perspective, since this helps to provide a more rounded and well-informed understanding of what customer success management is and why it is important. So, okay, enough from me, Rav. It's high time I stopped giving my own opinions and started asking you some questions. So let's begin at the beginning, if we may. Could you please start by giving us just a brief overview of who you are and where you've come from?
Of course. Well, as you mentioned, Rick, my name's Rav Dhaliwal. I like to describe myself as a recovering software executive. So I think I've been for the last 20 to 25 years, I've been in enterprise software business, various roles from support to consulting, professional services, and what we call customer success. I started my career actually working in sort of very large global multinationals, companies like IBM and so on and so forth. And then for about the last 12, 13 years, it's really all been startups. So I've been fortunate enough to be very early in 3 or 4 startups. A couple went off to be acquired, and then 2 went public. And so I was there all the way from the beginning to public exit. And as you mentioned, after I finished working at Slack, pretty exhausting, really, 4 startups in a row. And I was actually also looking for getting just more exposure to different types of technology and different types of companies. And so joining the sort of venture capital world was a really good, natural, logical choice, in so much as it really gives me a lot of very interesting exposure to new companies, new technology, I love working with founders and founding teams. So that's a little bit of a potted history of what I've been up to for the last couple of decades.
Yeah, no, it must be very exciting. Actually, I can see why you're attracted to doing it. Most definitely. So thanks, Rav. It's always good to get an understanding of who you are, I think, before we dive into the topic itself. So thanks for that. Okay, well, let's dig into our topic then, which, just to remind everyone, is customer success management from the investor's perspective. And let's start with the basics. What is venture capital and who are venture capitalists?
Oh, that's a great question. So venture capital is really a term for investing. It's a specific type of investing. It's typically investing in companies that are privately held. They're not publicly traded companies typically. And it's about investing in companies at different stages in return for equity, right? And sometimes those investments will come with a seat on the board or a board observer seat, or sometimes it's purely a financial transaction in return for stock. There's many different types of investments you can make. There are priced rounds. There are things called safe instruments. There's all different types of financial instruments, but ultimately you're really buying a share in the company. Venture capitalists tend to have quite a diverse background. They're broadly, there's a bunch of them from finance, banking, accounting sort of background. There are venture capitalists who used to be entrepreneurs, so they have run successful companies. And then the third bucket, which I would sort of consider myself in, there are VCs who are what we call used to be operators. So they used to be in companies, they would be in an executive role, or they may be a general manager or a VP or SVP, and they've got a breadth of experience which makes them kind of a useful asset to not only invest but also to support those companies. So that's broadly what venture capital is, and the kinds of people who kind of make up the venture capital industry.
All right, and as you said, obviously it is it's a broad array of stuff going on there, but in summary format, I mean, obviously businesses that are in early growth phases need funding because they need to grow and they need to support that growth, and they're not going to be able to do that through revenues in the early stages necessarily. So I think that's easy to understand, that we need some capital in order to grow. So why would a company opt to obtain their funding from a VC fund, for example, rather than, say, going to a bank or some other route? What is it about a VC fund that is useful in those early growth stages?
Well, it's a good question. I mean, people do take debt financing. You know, they will go out, and especially at the moment, money's really cheap. Interest rates are really, really low. So, you know, in some instances, that is a perfectly viable alternative. But in others, it can be an indication that actually there aren't people willing to take a bet on you. So you have to go take money from the bank. So it's almost a kind of affirmation that you're onto something because a venture capitalist has done a due diligence and worked with you and looked at the business and the product and go, well, actually, I think this is a backable proposition, right? So right. The other reason where you may want to go down the venture route is, and depending on the fund and depending on the level of investment, is the support that you'll get. So many venture capitalists have access to a vast array of experts. Some of the firms have, like ours, a very well thought out platform to support companies. If you think about it, it's really a customer success engine inside the funds to support the portfolio, right?
Yes.
It is one way to think about it. So instead of selling software and making you successful with it, we're giving you cash and helping you become successful with it. So that's just some of the reasons why some people may want to go down that route. And also actually access to, and it's very typical for multiple investors to form a syndicate and invest in a company. So it may well be that rather than taking money from one bank who's not going to help me beyond giving me the money, why don't I get investment from 2 or 3 different investors who can bring different perspectives, different skills and experience and resources to help me build my business? Right.
And presumably also to add to, I mean, I'm assuming that if things go well in round A, when you look to round B, there it is, because if it's going well, and assuming that the VC fund, it isn't just more like an angel or whatever, and wants to continue investing, there they are, and there it is, as it were. So it's kind of
Yeah, well, I think it might just be useful. It might just be useful to define somebody's terms for the folks listening, because they may not be familiar. So angels are typically investors who are individuals. They may be often they're entrepreneurs or people who are maybe a bit later in their careers and want to invest in other companies.
But it's private money. It's a person's money rather than a company's money.
It's a person's money. Exactly. It's not an institution's money. Sometimes it's called friends and family investing, but there are people who do nothing but angel investing.
Absolutely.
And they will tend to, in the very early stages, write sort of very modest size checks, and typically that will bring in a founder or a founding team. A number of things. It will obviously be a cash infusion of some sort. If that person is pretty high profile, has a good track record, it's a good. It looks great for potential future investment to say I have these high profile angels. And the other thing is it helps to what we call bootstrap the business, so you don't have to give away so much equity up front. Typically, then what happens is that one of the first investor stages is called the seed stage, and this is sort of anywhere between a few $100,000 and maybe $1 or $2 million or $3 million. And this is where the early funds, people who invest at that stage, will be looking to invest because they believe that actually this is a very long-term proposition. But and then the funding rounds tend to go alphabetically: Series A, Series B, Series C. But to get from the seed stage to Series A is hard. That's the phase where most businesses fail. Okay. And that's because of various reasons. Yeah.
Well, so in effect, the seed stage, really. I mean, just like it sounds. I mean, you sow seeds, not all of them come up, right?
Correct. Yeah.
So what you're doing there is you're looking for the proof of concept at that stage.
It depends. I mean, some businesses are a bit more advanced. They will have actually got some repeatability. Generally, what you're looking for is either a number of variables. You're either looking for a backable team, people with a really good track record, who are, we know they can execute, right? They've got the pedigree. Or we're looking for that, plus potentially there is something really unique proposition about this product they're building. It solves a hair on fire problem. The technology is really innovative. At Crane, we've invested in intelligent computing, deep tech, machine learning, AI. There can be often a lot of really amazing solutions there. And then you're looking at, well, how we've met some of those criteria. What about the addressable market? Is the addressable market big enough that if this company takes traction, it could be $100 million, $200 million, $1 billion revenue company over time? So you're looking at sort of these other variables, the competitive landscape, all that kind of stuff. So, but in order to get to a Series A, you really need to have some kind of repeatability in both the products working and people are buying it, even though you may not be doing massive deals. You may not even have a sales organization. It may be the founding team doing these deals, but you need to be, really approaching around $1 million in ARR to be thinking about having a successful Series A. So there's a lot of work to do between that seed and A, and the bets that you make there or don't make there will have a big knock-on effect to whether or not you're going to be able to build a successful company.
Thank you. So let me just summarize that, make sure that I'm clear. So, and in fact, one of the questions the next question I was going to ask you is what makes a good investment opportunity. And I think you've described that very well. So we're talking about the product, we're talking about the market size, the potential market size, the potential for growth. We're talking about the management team and whether they are the right people, and we're talking about the repeatability and the customer lifetime value.
Broadly, yeah. I mean, it's entirely possible that. Yeah, broadly, yeah. I mean, it's entirely possible that you have a very small market, but you have and it's a finite market, but your technology differentiation is such that if you captured even half of that market, you would still be a hugely successful business, right? So, it doesn't necessarily.
Well, if your product is worth $1, and you've got 1 million people, or you've got your product is worth $1 million and you've got one person, it comes to the same thing, doesn't it?
Well, consequently, you may be selling middleware for which there's only 1,000 buyers, but each of those buyers, if they bought it, would pay 50 million in recurring revenue. And then you would then charging some basic sort of consumption-based licensing. Then that's again can be a very attractive proposition if you believe in the team and you believe in the product. So
all right. Thank you for that. So look, if a venture capitalist does invest in a company, what actually happens? I mean, obviously, aside from the transfer of funds into the bank account. What might the agreement look like? What level of input into, or perhaps control over, decision making might a VC require in return for their agreement? Yeah, how does it work?
It works like software sales. So it is terms and conditions, contracts, negotiations, back and forward, based on a broad agreement of it's this amount of capital for this amount of equity with these amount of terms. Right?
And I imagine it does vary a fair amount, does it?
Oh, for sure, yeah, definitely. Yeah,
as to what those terms are.
It's very rare, as I mentioned, that you're the sole investor. There'll be other investors. There'll be, trying to achieve some uniformity in terms that everybody is happy with. Whether you're going to exercise pro rata rights, so in other words, you're going to reserve the right to follow on invest. There's negotiation over what the valuation of the company will be pre and post investment, how much dilution,
as in how it will be valued.
Not just that's the major part of the negotiation, is agreeing what the valuation would be based on the forward projection of the business and whether that projection is realistic or not. So it's a contractual discussion and back and forth, and lawyers are involved, etc., to get to what's called an agreed term sheet. Term sheet is the contract, and the contract defines the terms of what you're entitled to as an investor. Is it a board seat, board observer? Is it nothing? Do you have the right to follow on? Is there going to be a cap on the valuation of the investment? So it's just like any other sales transaction. If you've sold software, you'll be familiar with, you'll have your standard T's and C's. Do we do it on your paper, our paper? We need these clauses. We need these rights. We want to use English law versus US law. It's all those very similar kind of process. Yeah.
Yeah. And I'm thinking that you may, as a venture capitalist, look at an organization and think, well, the management team is great, except that I don't think they have experience in, say, financial management at this level. In which case, perhaps there might be a term around that you put into your contract to say, well, yes, we'd like to go ahead, but we want to we want to see you hire someone like this, or we want some input into this area where we don't feel you've got the expertise, or something of that nature. Or
that level of granularity is not likely to make its way into a contract. That's likely to be part of the discussion and negotiation. I don't think there are really many founders out there who would or should see to that level of micro control. This is very different from private equity, where private equity buys the company and owns it. I own 80% of the company, therefore I hire and fire whoever I want and install my own management, etc. Yeah, that's a very, very different proposition from venture. So venture investing is really about supporting the existing team that's there and bringing your network and your skills and your advice and your experience to help them be successful. It's a different model to things like private equity funding, which is we take over the company, we hive off bits, we sell the assets we don't want, etc., etc.
Mm-hmm. All right. So going back to the list of things that you mentioned that a venture capitalist might find attractive in a business, I think you mentioned the concept of recurring revenues sort of came up there a little bit, and the ability to, for example, sell software as a service on an annually renewable contract, for the sake of argument, rather than selling the software itself as a one-off capital purchase is obviously a classic example of that. So what is it about, and listen, I know it's a really obvious question, but I just want to be clear. What is it about renewable contracts that make them particularly desirable to VCs, would you say?
Well, I think just the opportunity for growing revenue from an existing customer base and not necessarily having to go out and keep finding new customers or keep having to build new products, etc. So, from a business model perspective, you see this even to the point where Apple now is becoming a recurring revenue business.
Definitely.
They're not just selling you the phone, they're selling you the subscription to Apple Music.
Absolutely.
They're selling you the subscription to the new. So, even the world's largest corporation is moving from,
definitely. Look at Microsoft with Office 365. Yeah.
Exactly. So it's very attractive. Margins are typically very good in software, and especially if it's recurring revenue software. So, the capital expenditure is much more minimal, and therefore the lifetime value of each customer becomes a lot greater because, once you've built the software, it's not like you have to burn it onto a CD, package it in a box, put it into a shop.
The unit cost is irrelevant. Yeah.
Exactly.
Yeah.
The unit economics in a recurring SaaS model business are very, very attractive from an investment
very,
point of
very
view.
scalable. Yeah. Yeah.
Yeah.
And I would say that, predictability comes into the picture there, yeah, in terms of revenues.
Well, one would hope so. But I think this is the journey that, VCs can really help companies go on is, what is the right pricing model? What's the right distribution model, for example? Because, if you're a consumption-based service, then you may have predictability, but not as much as.
Okay, that's the end of part 1. Part 2 will be released very soon. So for now, thanks very much from me, Rick Adams. And to make sure you get notified when it gets released, please sign up to my Practical CSM YouTube channel. Just type Practical CSM into the YouTube search box and my page will come up. Remember to both subscribe and select the bell icon for notifications. Thank you.